Welcome to Securities. All right, let us start off by looking at the term return on investment. A return on investment is basically the reward that you get for your investment. So you will either get interest if you invest money in a bank, for example, or you will get dividends if you invest in shares. So if you buy shares from a company, the reward that you get or the income that you get will be dividends. Here's a golden rule regarding the return on investment. The higher the risk of the investment, the higher the return. Let's look at the Johannesburg Securities Exchange, the JSE. What are the functions of the JSE? So the JSE links or connects investors to public companies. Remember, public companies are companies listed on the JSE. So the JSE will connect the investors to those public companies. JSE will also keep the investors informed. Remember, the JSE will publish prices on a daily basis. So the JSE also keeps the investors informed by publishing share prices daily. Finally, the last function of the JSE is that we can look at the JSE performance as an economic indicator, right? In South Africa. So we look at how the South African companies are doing on the JSE to see how the economy is doing. So the JSE prices can be used as an indicator of economic performance. Now let's talk about shares. Share is basically the percentage of a company. So when you buy shares, you are basically buying a certain percentage of a company. And we've got 4 different kinds of shares. We've got founders shares, we've got bonus shares, we've got ordinary shares, and on the next slide, we've got preference shares. So let's discuss each one. Founders shares, these are shares given to the founders of the company. The founders of the company are basically the people who started the company. Now, they will receive a dividend last. They will receive their dividends after all other shareholders are paid, right? Because they are the founders. Let's look at the bonus shares. Now, bonus shares are paid as a reward for unpaid dividends. Now, let's say for some reason the company did not make profits, so it was unable to pay a dividend to its shareholders. The company can give those shareholders bonus shares. Right? So the bonus shares, these shareholders, they do not pay for. They are given as a reward because the company could not pay dividends. Ordinary shares. Ordinary shares are ordinary because you will only get a dividend if the business makes a profit. If the business does not make a profit, you will not get any dividend. So the higher the profits made by the business, the higher the ordinary share dividend. Now, number 4, the 4th kind of a share is a preference share. This is the special one, and the word preference suggests these shares get preference for dividends. So the shareholders will receive a dividend whether the business makes profits or not. Right? This is why they are preference shares. They are preferred because they get a dividend whether or not the business makes a profit. They are paid to shareholders at a fixed rate. So they're not dependent on profits. They are paid at a fixed rate. So if the preference share dividend is 5% of your investment, you must get that 5% no matter what. So they are paid at a fixed rate. All right. These preference shares can further be divided into 4 categories. We've got cumulative preference shares. Cumulative means to accumulate, so they receive unpaid dividends from the past as well. Number 2, non-cumulative preference shares. These ones do not accumulate, so they do not receive past dividends. Number 3, convertible preference shares can be converted either to ordinary shares or cash. Non-convertible preference shares cannot be converted to ordinary shares or cash. All right, that's the end of the section on shares. Now let's look at investments. We've got 5 different kinds of investments. We've got retirement annuity, unit trust, debentures, we've got a fixed deposit. Lastly, we have a government retail savings bond. So let's look at each one. Now, the key word with the retirement annuity is retirement. So you invest money, but you only get this money when you retire at the retirement age. Unit trust, the key word with the unit trust investment is the word unit. Unit means one. So many investments are pulled together into one major investment that will be managed by an expert. So unit trust, unit means one. So many investments by many people can be pulled into one, and they will be managed by an expert. Debentures, number three, this is basically when the company borrows money from the public, from people in the public. So the company issues them with a debenture certificate that states the interest and when the money will be paid back. Number four is the one we are familiar with, the fixed deposit. So when you go to a financial institution like a bank and you invest money, and you can only withdraw this money after a specific period, right? So if you invest money in a fixed deposit for 6 months, you can only get that money back after 6 months. Of course, you will get it back with interest. What are the advantages of a fixed deposit? The interest remains fixed. That's why it's called a fixed deposit. The interest is fixed despite economic conditions. That's number one. Number two, the investor can choose the period that suits them. You can choose whether they want to invest for 6 months, 1 year, 5 years, but that is linked to number three. The longer the term of the investment, the higher the return. Okay, now let's look at the last type of investment, which is the government retail savings bond. Now, the business here lends money to the government at a fixed interest rate, right? Remember, sometimes the government also needs money, so the business can lend money to the government. What are the advantages of government retail savings bond, lending money to the government? The interest rate here is also fixed for the whole investment period. All right. Secondly, the interest rate is higher than that of a fixed deposit, which you would open in a bank. So you get a higher interest rate, or the business will get a higher interest rate than a fixed deposit account if it lends money to the government. Also, this one is very important when it comes to the government retail savings bond. Interest can be received twice a year. It's very important. With other investments, interest is usually received per year, but here interest can be received twice a year. Now, lastly, we can look at the difference between simple interest and compound interest. The main difference with simple interest, the principal amount stays the same every year, but with compound interest, the principal amount accrues or accumulates every year. Secondly, the interest rate under simple interest will be lower. So the simple interest will offer you lower interest than compound interest. Obviously, it's higher for compound interest than it is for simple interest. That's just the opposite of the last fact there under simple interest. I would encourage you to go see the finance video, the finance maths lit video, so that you will know how to do calculations for simple and compound interest, because those are also required for your exam. All right, thank you, grade 12s.